Hi everybody, welcome back to the channel, and today I wanted to briefly discuss how much it would take to make $1,000 per month from the Schwab U.S. Dividend Equity ETF. First thing to look at here is this number, 250,000. We're going to start with that number and just kind of play around with it. So here's the chart of SCHD. This is basically the Dividend Equity ETF. They try to keep it low volatility as well. So what you're looking at here is a beta of 0.88, which basically means it's going to be less volatile than the S&P 500, which is probably a good thing if you're looking at dividend income, especially in retirement. If we take 250,000 and we just kind of factor in the current yield, we can look back at the previous dividends, and we'll go over here to NASDAQ, which has the most recent dividend history, and we have a dividend yield of 0.0388. So what we'll do is we'll take that times 250,000 and we'll find out how much that is actually on a yearly basis, just based upon that initial dividend yield. Now keep in mind this yield will change, and also these dividends can go up or down month to month. You probably saw some variability there with the dividends, and they did just do a forward split as well, 3-for-1. So keep that in mind. The dividends now are not going to be like in the 70s. They'll probably be lower down here. But to get the old dividends, you can just multiply by 3 because they did a forward split, 3-to-1. But this most recent dividend was just over 75 cents if we factor in the one before they did the forward split. So actually 26.2645. And you can see these variable dividends before. Now going back, I've mentioned this in other videos, but SCHD has dividends that have really gone up. If you look at like a plot chart or something like that, you would see the consistent trend in terms of the dividends going up over time. So that's a good thing. That's what we want, right? We want dividend appreciation. And that is one of the things that this ETF says that it is focused on. So it's not just about the initial yield. It's also about the dividends that you're getting as you invest over time, long term. What does your dividend stream grow into, and how much in dividends are you earning from this ETF? And as I've discussed also, the wheel strategy, you can combine potentially the wheel strategy along with dividends. We're going to talk about that briefly in this video as well. But take for example, if we come over to this calculator, we multiplied $250,000 times 0.0388, $9,700 a year. Now that seems like a pretty good chunk of change to invest for only $9,700 a year. That does come up to $808 per month. But remember, this is just a starting point. Assuming over the next 5 years that these dividends continue to grow, even in a recession. That's one thing about a lot of these dividend stocks in these higher growth long-term, not higher growth, but lower growth long-term businesses, which have been around for a long time. A lot of them have a history of growing their dividends, even in recessions, right? Some of them have grown their dividends for 25, 50 plus years. So you may be starting with, let's say, $800 a month if you invest $250,000. But the idea is with an ETF like this, if you hold this for 5 or 10 years, even if you do absolutely nothing, even if you don't reinvest or do anything else, your dividends, $800 a month could turn into $1,000 a month, $1,200 a month, maybe even more in the next 5 or 10 years. And so that's always a consideration, just because the companies that this ETF is investing in are increasing those dividends over time. So that's the first thing we can look at. If we wanted to go a little bit higher, we could probably get to $1,000 a month, I think, with $300,000 invested total in capital. So if we take 300,000 times 0.0388, you can pretty much factor that we'll be doing $1,000 a month, 11,640, or just about, maybe just under $970 per month. So that's a good chunk of change, like I said, to invest. But we're focused on the long term with this. We're focused on how do we earn those dividends, well into retirement, and just kind of build that good base. Because if you can put $250,000 or even, $100,000 or $200,000 into an ETF like this and roll this and reinvest dividends and also put additional contributions in over 5 or 10 years, you may be very surprised when you come back to it. I mean, that's the beauty of compounding. If you're continually putting money in on top of reinvesting dividends, yours $970 a month may turn into $3,000 a month, $4,000 a month. And that's when it can get really serious. And that's when it can get really exciting, because then you're starting to get to the point where you can maybe start paying some bills with your dividends and really start doing some things that maybe you've always dreamed of, like taking a vacation, or, the possibilities are endless, especially as you enter retirement and you have that dividend snowball. It's no different than when you're trying to basically, if you think about paying off debt, right? So if we go to, anyway, same concept, but we'll go over to options trading now, I want to show you something, because what we're looking at with options trading and the wheel strategy, you can potentially combine dividends along with the wheel strategy with this ETF. So what we'll do here is we'll take a look, we'll sell to open, and we'll just basically try to put in the number of contracts. So if we put in 250,000 initially, that's 92 contracts divided by 27. And this is basically for cash secured puts. And we also have covered calls we can do. That's what the wheel strategy is. And so we're going to be doing this against SCHD. We'll put in the symbol and it'll pop up for us here. And so we'll put in 92 contracts, put option, sell to open. And this is just the beginning of the wheel strategy if you wanted to do this. The January 17th expiration has put options priced at 10 cents per contract. So right there, we can earn $874 if we were going to put in $250,000 into this ETF and do the wheel strategy against it or something like that. Now, that would be a lump sum, right? So that would be maybe assuming you got your shares called away, and then you want to, on a covered call side of this, and then you want to turn around and do a wheel strategy put to get back into your position, right? That could be an example of how this works. Now, on the call side, we flip it to calls, right? And then we start taking a look at the expiration days because, as I mentioned in my last video about the wheel strategy and this ETF and how this works, if you look at the most recent ex-dividend day, 12/11, we can probably assume based upon the history over the last couple of years that the next dividend will be paid probably in March. And that's when you can expect the next ex-dividend day, 3/22, 3/20, so around that time frame. So what we really want to try to do is try to find an expiration that is past the March expiration. In this case, we can look at the April expiration. And assuming, let's say our shares got called away at $27 and we want to try to turn around and sell, assuming we, got long via cash secured put and we want to turn around and sell a covered call. That's what I was trying to say, because that's just in rotation for the wheel strategy. Now we actually own 9,200 shares or 92 contracts. Once again, this is the equivalent of $250,000. We're simply taking 250,000 divided by 27, and we can sell 92 contracts. That is what allows us, because once we take 9,200 shares divided by 100, we know that each options contract is the equivalent of 100 shares. And now we can do the wheel strategy with an expiration that is farther out from that expected next ex-dividend day. Now, the idea with this is to collect the $8,000 in premium on top of, and that's roughly over the course, I would say, of 3 months, let's call it, not 3.5 months. And so you can divide that up times 3. If you did that 3 times a year, you could be looking at $24,000 or an additional $2,000 a month, just an example. So you'd only have to repeat a trade like this 3 times in a year, and you could have $24,000 just from doing this. And that's what's so cool about this. But then when we look at, like I said, the ex-dividend day 3/20 or the next expected one, that's kind of what you have to look at with this. You have to compare the expiration day that you're doing this against versus the ex-dividend day, because what we really want is for the buyer of the call option to do nothing until the expiration day, at which point the option either expires worthless or we get our shares called away on April 17th, 2025. A lot of times what will happen, though, since exercision is random, at least until the expiration day, we know that it's totally random whether or not our shares will actually get called away when we sell this. So there's a possibility that we might get to keep our shares all the way till the expiration day. So in that case, even if this isn't the money and our shares get called away on April 17th, 2025, we've still collected the $8,000 no matter what. But then we can also potentially collect this next dividend, which is coming up, assuming the buyer of the call option does absolutely nothing. So that's the whole idea, is to have the buyer of the call option do nothing, and then we get our shares called away once this dividend is actually paid out, let's say late March. And then the expiration date for this option comes around on April 17th. We've already collected the dividend. And now let's say the option is in the money, our shares get called away, and we turn around to the put side of things, and we repeat the process again. But that's kind of an idea of how you can make additional income in addition to, let's call it $250,000 to, if you want to put $300,000 or pretty close to, with the current yield, like I said, take 300,000 times 0.0384, I believe it was, and that will give you the exact yield or the exact amount of about $11,000, almost $12,000. $960 initially. So that puts you roughly at $1,000 a month, and that kind of explains initially what you would need to get $1,000 plus. But long term, that $1,000 could turn into a lot more. And with the wheel strategy, we might be looking at more than $1,000 already, maybe even $2,000 or $3,000 a month, just from, let's call it, a $300,000 portfolio here in SCHD. So hope you guys enjoyed this video. That's how much it would take to potentially earn $1,000 a month from SCHD just in dividends. Would be $250,000 to $300,000, let's call it. And hope you guys enjoyed the video. We will see you in the next one. Take care.